in the classic finance book, The Richest Man in Babylon, the principle for having money in your purse to pay for expenses is pushed. It's such a simple concept, but across the globe, most people can't manage it. Joining us in studio to tackle the debt theme is Warren Ingram, Director at Galileo Capital. Warren, it's always a pleasure having you on the show. And of course, we're continuing with this debt theme, how you keep out of trouble. I think that's perhaps the starting point here.
So, I mean, the simplest answer is don't buy the item in the beginning, but I guess that's difficult for all of us to do. I mean, I think it starts with understanding yourself and delaying the instant gratification urge that we all have. You know, I mean, it's our generation, it's also human nature that what we see and what we want right now, and we're not going to wait for it. And I think that's the beginning point of all of this, is if you can just hold off a little bit of time and rather save for that, because I think the inclination here is I need a new fridge or you know, a fancy couch, and I'm going to get it on debt because the store can give it to me and I can pay it off at 100 Rand a month for the rest of my life. And rather don't do that, rather save up and pay for it cash.
But how do we buck that trend? Isn't that ingrained in ourselves as human beings, self-gratification? I mean, this is going to take a lot of psychology lessons to buck the trend.
Garth and I were chatting about it yesterday, sort of this behavior in terms of how do you actually budget. I mean, it is a simple concept. To spend less than you earn. I mean, it can't be that difficult, and yet we have a world that spends more than it earns. It's bizarre. One thing we were chatting about yesterday was, like, have you ever actually been faced with the reality of doing your own budget? And I was talking a bit about, often, you know, you go out and you say, I intend to spend 200 buying drinks tonight, and it ends up being 280 or 300. But in your head, you've always said, I budgeted 200, therefore I spent 200. And what I found quite interesting is quite nice tools, the 227, there's the Money Smart tool, and basically what it does is it takes your actual spend out of your bank account, and it says, well, what do you actually spend things on? So I can put in, I use Pirate Sports Club, and I know that's me going for drinks on a Saturday. And every time it comes up, and in my head I think, I must have spent 500 bucks at Pirates in terms of my drinks. And then when I actually pull this report, I can see, well, it's actually twice that. And I think, I think we hate being faced with the idea of what a real budget is. If we put with what I actually spend each month, it's a wake-up call for you.
Let's make this personal. Have you got your budgeting right, Garth?
I have to say that, you know, without blowing my own trumpet, generally I've been pretty good at managing my finances. I think I inherited my mom's genes there. But, you know, I think going back to what Mark and I discussed yesterday, a lot of it comes down to behavior. And I tend to think you can have all the fancy tools and spreadsheets in the world. At the end of the day, to be really brutal, if you can count, you should be able to balance your budget. You earn X amount, make sure you don't spend more than that. And you know, I use the example, speaking to Mark yesterday, it's almost like someone with an eating disorder, someone who eats too much. You can give them a fancy tool to weigh the food that they're eating, to count the calories, but that's not necessarily going to stop them from wanting to go out and eat. You actually have to address the fundamental behavior, and it's very common in South Africa. We want to spend more than we earn because we have this bling culture of wanting to show off to everyone, and I think people need to really look at that.
If you use that analogy, we're almost speaking about a disease here.
It is. That's 100% right. So the analogy between the health and obesity specifically is a classic one. It's exactly the same. I mean, obesity is the problem of just, you know, constantly putting in because you want it now and it tastes good and forget about the consequences. And especially credit is exactly the same. Instant credit, you know, overspending. It's a behavioral issue. And I think your first comment was right. It's about psychology. I think one of the things, one of the solutions is then to actually budget for fun, to budget for spending things on, you know, spending your money on frivolous things, and allow yourself to do it, because at least then you're not delaying all gratification. And I think that to me is a good starting point, but at least have it as an item, and you say, well, this month I'm going to blow 500 Rand on absolutely useless things, but I can do it. And then you have that kind of thrill that you're looking for.
It all comes down to education as well. And again, picking up on our theme on the cover story, are we taking this seriously enough?
I don't think so.
Are we spending enough time on education?
I think there's a lot of attempts at education, but the education isn't necessarily being translated into action. We can all talk about it and say the simplicity of it, but I think one of the things that doesn't get communicated very well is the duration of being in debt. You know, I blew up a business about 4 or 5 years ago, and it takes you 2 years to pay that back. It's not just, well, I'm now going to stop spending. You're stuck in the cycle where you're now paying back the mistakes that you made 2 or 3 years back, and it takes you to, there's an opportunity cost to that. So I think you've got to be very careful about what you're spending on when you go out there to spend it. If you're putting money into a business, make sure you understand what your cutoff point is, because very often, the psychology that happened there was essentially you're saying, I want to put my capital in, and then I think, just one more month, I'll be better. I'll get through it. I'll get through it a little bit more credit. And the problem is that the gap just becomes so wide that you can't get out of it. You can't untrack.
It is a balancing act. Are you advocating in favor of no debt?
No, because without debt, most people wouldn't own any assets. I don't think debt is a bad thing as long as you know how to manage it properly. I think debt, when institutions are charging 31% interest, is a bad thing, and I think that needs to be looked at. And just going back to education, I think education is important, but in South Africa, too often education focuses on teaching people the fundamentals of finance and less on teaching people how to alter their behavior. And I think you need to make, exactly what Warren said, delaying gratification. You need to make that a virtue and not make bling a virtue, which is unfortunately the societal norm in South Africa.
I would say no to debt without education. That would be an absolute pointer for me. The people giving you the credit, they have to educate you, and they have to do it properly and sustained. Then they're allowed to give you the credit. That would be my solution.
Are we back to this environment of reckless lenders? Small microfinance organizations going out there and chasing their money with a baseball bat afterwards. Are we back to that kind of environment?
Well, I think we somewhere in between where we were in the very bad old days, and I mean, at the same time, these are people that are trying to do business. So I mean, you can't. This is also, there's a demand for credit. So I think yes, there are some unscrupulous practitioners out there, but at the same time, it's desperate people who are looking for money at any cost. They have to get through this month. Forget about next year.
What about the health of the South African consumer? Analyst after analyst sits here talking about the retail space on a nightly basis, on a daily basis, saying the South African consumer is in good health. Is that now a fallacy?
Well, I think you can look at, we saw a couple of those research reports saying how consumers are shopping at Woolworths. There's been a noticeable shift from those that are spending with cash and those that are spending on their credit card. And again, that's not the poor community, that's your Fenton housewife, essentially using your credit card to shop at Woolworths. So I think you can see the bubble that's translating into what you can see in terms of the retail figures. It looks good, but at some point that's got to be paid back. And I think we were talking about the NCA earlier in terms of the way that businesses lend. Businesses are going to come up with ways to lend. You can put as many rules in place as you want, but you can come up with payment plans that'll take you 20 years to pay, or 500 Rand if you want it. I mean, businesses will work ways around the rules that you put in place. And I think that's what you're seeing at the moment.
Warren, this brings a bigger issue to the table, and it comes again to the conversations that I've been having with analysts on a nightly basis, is that it sounds as though this bubble is now translating to a retail bubble, and those stocks, those companies, could be ready to fall off a cliff, and we're not seeing this coming. It could just be that train coming straight for us.
I think it's not there that the problem is. I think it's it's much more around. I mean, you're talking about unsecured credit and providers who are not in the normal space, they're not in the listed space, and I think that's where the problem is. Not so much, in my guess.
But I'm just taking that anecdotal evidence now that Mark shared with us from the research. It's actually not anecdotal, it's from research saying that a Woolworths customer is now choosing her credit card over a cash component. That already shows a level of stress that perhaps hasn't been built into these retail stocks. I know you're not a stocks, I'm not trying to push you, but I'm just saying, as a broader industry.
I mean, so listening to Ian Moyer last night about this, and he was saying they don't have this unsecured credit problem. They don't see it as a problem. If I read between the lines, he's saying the opposite in a way. He's saying that his consumers are in good health and they are spending sustainably.
Garth, as companies editors, do we believe now what's coming out of the retail stocks?
I personally don't buy it, because I think your average sort of middle class consumer has had a reprieve from the low interest rate environment. So your home loan is costing you less, your car payments are costing you less, and maybe you're a little bit more worried about whether you're going to keep your job, so you do curtail some of your spending. But the fact is, if you go out and speak to people, most South Africans are one paycheck away from financial ruin. And it's not about poor people versus well-off people, it's everyone. At some point, we might have record low interest rates now, but at some point the interest rate cycle is going to turn. So maybe for the next year or so things are hunky-dory, but at some point when rates start climbing and those home loan payments, mortgage payments start increasing, I think people are going to start hurting again, and things are going to fall down very quickly.
Yeah, I mean, and I think maybe too, I mean, the comment that from Ian Moyer, I mean, I think it would be, maybe it's a cynic in me, but I do think you also have to be a little bit careful about what they define as unsecured versus whether, you know, do you count your credit card as unsecured lending? You know, is it an African bank loan that's being used to pay your buying your shopping at Woolworths? And you can see it. I mean, the African Bank put out their quarterly trading update. People are using their loans to put in for deposits on houses or deposits on cars. And then you only say, well, do you count a credit card as being unsecured lending in the traditional sense of it? So I think you can be a little bit clever with semantics. You know, I think there's a little bit of semantics there, and I think you do need to interrogate those numbers a bit more closely.
Okay, let's not get too down in the doldrums here, because I'm about to, this is Friday, guys. We're supposed to be celebrating at the end of the day, and now I don't know whether we should actually go, just carry on working because we've got to make more money. Well, there we go. Studio saying it's not payday for them today, so our team's got to wait until at least Monday before they see those bank balances changing. Come, let's talk about solutions, positivity here.
So, I mean, I think the one basic point in this is that for people who have debt right now, this is the equivalent of a bull market. This is the time to be paying off that debt as quickly as you possibly can. It's as cheap as possible. It's as cheap as it's ever going to be in your lifetime. The fact that it might go down another 0.5% is irrelevant. It's incredibly cheap. Now is the time to be smart, to actually pay down the capital as well on your debt. Don't spend more simply because you've got a bit more free cash because your bond is a bit cheaper. That's the crazy thing to do.
What about, we've chatted about this before, setting your bond rate at current levels? We did say there could be a potential another 50 basis points in the offing, etc., etc. But surely we've got to be as close to the bottom as we're going to get, or is that a rather brave statement to make?
Yeah, I think it depends on your terms. I mean, you can set it for a short term at current rates, but what's going to happen? You know, let's say we stay at the same level of roughly the same level of interest rates for the next 4 or 5 years, and you're fixed at a certain rate for 1 year, and then you've got to go on for 4 or 5 years at above the rate that everybody else is paying. I think the reality is globally things are tough at the moment. It's going to need a lot of stimulus to drive. I mean, we're talking QE3 now. I mean, you're looking for stimulus to try and get that economy going. You know, why not ride it out? If you're so indebted that a couple of percentage points is going to absolutely throw you, I think you've got to be a little bit careful.
Garth, anything to add there?
I would just, you know, sort of back up what Mark said. I think it's a bad idea to fix your mortgage. Banks aren't stupid; they always win. And they will fix your mortgage for a short period of time, 2 to 3 years, and they'll also do so at a premium above the current low interest rate. So you're not going to win in the long run. Just ride it out, listen to what Warren said, get your finances in order, and start getting prepared for rates going up one day, because it will happen at some point.
Well, there's the salient advice. Banks will always win. Thanks to Warren Ingram from Galileo Capital. Time to head into a short break. More FinWeek Money Matters right after this.